Hi, everyone, and welcome back. Today, we're talking Alphabet, first quarter of 2026. The headline looks spectacular. Net income up 81%. But dig in, and the quarter gets weirder by the page. Cloud reaccelerated, CapEx more than doubled, and stock buybacks just went to zero. Let's unpack it. Net income up 81%. EPS up 82. That's the line every analyst tweeted at 4:30 Pacific time. Here's what they tweeted less. $36.9 billion of that came from an unrealized gain on equity securities, paper, mark to market, and it flowed through to $28.7 billion of net income after tax, almost half of the headline. Strip it out, and operating EPS was essentially flat year over year. The actual operating business grew 30%. The headline grew 81%. That gap is the entire deck. Take the tiles top to bottom. Revenue grew, operating income grew faster, net income grew faster still, and EPS grew the most. Each line accelerates as you move down the chain. That's operating leverage, compounding into a record EPS print. With the footnote we already covered, half of that EPS lift was paper. Now flip to the cash side. The income statement just told us this was a record quarter. The cash flow statement tells a different story. Alphabet is paying for it. Operating cash up 27%, healthy enough. But CapEx more than doubled, free cash flow halved, and stock buybacks went from $15 billion last year to zero this year. Same quarter. Two very different companies. $109.9 billion in a single quarter. Up 22% year over year. That's the 11th straight quarter of double-digit growth. For a business doing nearly $500 billion in annual revenue. There are maybe 2 or 3 companies on Earth that can do this. 6 revenue ribbons on the left. Search, YouTube, network, subscriptions, cloud, other bets, all merging into total revenue. From there, cost of revenue peels off first at $41 billion. The remaining $68 billion of gross profit splits 4 ways, 17 for R&D, 8 for sales and marketing, 4 for G&A, and what's left, $39.7 billion, is operating income. Now look at the long ribbon arriving from outside that chain. Other income, net, $37.7 billion, almost as wide as operating income itself. 36.9 of that is an unrealized mark-to-market gain on equity securities, paper. After tax, that gain alone contributes $28.7 billion to net income, and the headline lands at 62.6. That side ribbon is the entire reason the headline grew 81%, while the operating business grew 30%. 3 segments, services, that's search, YouTube, subscriptions, and devices, is the engine, at $89.6 billion this quarter, up 16%. Cloud, that's GCP, Workspace, and AI infrastructure, $20 billion, up 63%. Other bets, Waymo, Wing, Verily, $400 million, still loss-making. And then a fourth line that doesn't sit in any segment, Alphabet-level shared AI research and development. That's a $5.4 billion drag this quarter, up from $3 billion a year ago. AI is expensive even before you allocate it. The competitive map, 4 hyperscalers, Alphabet, Microsoft, Amazon, Meta, and Alphabet is the only one ticking every box on the slide. A frontier foundation model? That's Gemini. Custom AI silicon, TPUs, a hyperscale public cloud, yes, a multi-billion user consumer surface, search and YouTube, a dominant ad network, yes, and the one row Alphabet has alone, a robo-taxi fleet, that's Waymo. Pichai calls all of this the vertically integrated AI stack. This matrix is what he means. Now the revenue side, cloud is the protagonist. The revenue mix, search advertising is still the engine. Over half of every dollar. But look how cloud has grown. It's now 18% of total revenue. A year ago, it was 13.5%. 2 years ago, under 12%. Cloud's slice is bigger than YouTube ads, plus the entire network advertising business put together. The shape of Alphabet is changing in real time. Inside services, 4 subsegments, search and other, that's the core ads business, grew 19%, the fastest in years, subscriptions, platforms, and devices also 19%, YouTube ads 11%, and then network advertising. That's third-party ads Google sells across other publishers' sites, was down 4. Network is the chronic shrink. Everything else is up. The story this quarter is that search reaccelerated after a couple of quarters of fear that AI overviews would cannibalize the ad inventory. Apparently, it didn't. Plus 63%. Cloud revenue. A year ago, that growth rate was 28. 2 quarters ago, it was 34. The thesis that hyperscalers are maturing, that the cloud market has crossed peak growth. The thesis was consensus 3 months ago. This number breaks it. And remember, this is reported revenue. Bigger than that, Sundar told the call that cloud revenue would have been higher if they could have met the demand. They are compute constrained. Sold out in plain English. 2 things normally don't happen at the same time: revenue acceleration and margin expansion. When the top line is racing, mix usually skews to lower margin volume. Not here. Cloud revenue grew 63%. Operating margin almost doubled, 17.8 to 32.9. Operating income tripled from $2 billion to $6.5. And here's the part that tells you why. Revenue from products built on Alphabet's Gene AI models grew 800% year over year. AI revenue isn't margin dilutive at Alphabet, it's the opposite. The number that shocked the call. Cloud's backlog, the contracted but not yet recognized revenue, was $462 billion at quarter end, nearly double what it was 3 months earlier. About half of that converts to revenue in the next 24 months. So, $230 billion locked in over the next 2 years. That's more than a year of total Alphabet revenue contractually committed just for cloud. The number of $100 million to billion-dollar deals doubled year over year. Existing customers exceeded their initial commits by 45%. They are eating capacity faster than Alphabet can ship it. The thing everyone has been worried about for 2 years was that AI overviews would eat search ad inventory. The actual number this quarter says the opposite. Queries are at an all-time high. Ads revenue grew 19%. Sundar said latency on the AI features is down 35% over 5 years, and the cost of running core AI responses fell 30% in 1 quarter after they upgraded to Gemini 3. They're getting faster, cheaper, and growing revenue at the same time. 350 million people now pay Alphabet a recurring fee. That's not search, that's not ads, let's go Wayne, that's subscriptions. YouTube Premium, YouTube Music, Google One, the Gemini app's paid tier, an NFL Sunday ticket. The subscriptions, platforms, and devices segment grew 19%. YouTube Music and Premium had its biggest non-trial conversion quarter since the service launched in 2018. This is the quietly compounding annuity in the deck. Nobody talks about it. Then one day, it'll be 20% of revenue. YouTube is now the most watched streaming platform in the United States, 3 years running. 200 million hours of YouTube watched on the TV every single day. 10 million channels publishing Shorts daily. Shorts is now its own creator economy. YouTube ads grew 11%, with direct response leading and brand catching up. This isn't a video platform anymore. It's a parallel TV network the size of all the cable networks combined. Geographic mix. United States, $54 billion, up 23%. EMEA, $31.5 billion, up 21%. Asia Pacific, $18 billion, up 23%. Other Americas, $6.25 billion, up 21%. Notice anything. Every region grew between 21 and 23%. That's unusual. Big companies usually have one weak region. This was strong everywhere. The constant currency rate was 19. 3 points of growth came from foreign exchange tailwind, which management said will fade to about 1 point in Q2. Now the cost side, where the quarter gets strange. Here's the income statement as a waterfall. Revenue 109.9. Subtract cost of revenues, R&D, sales and marketing, G&A. You land at $39.7 billion of operating income. That's a clean 36-cent operating margin. Then look at the green bar, plus $37.7 billion of other income. That's not from the operating business. That's a mark-to-market gain on equity holdings. They own slices of private AI labs, public stock, infrastructure investments. The market re-rated those holdings up $37 billion. After $15 billion of tax, you land at $62.6 billion of net income. Half of that came from the operating business, the other half came from the market. This is the chart that defines the quarter. Capital expenditure by quarter for the last 5 quarters. 17 billion, 22, 24, 28, 36. Doubled in 5 quarters. And look at the year-over-year growth rate at the bottom. 43%, then 70, 83, 95, 107. The rate of growth of CapEx is itself accelerating. Anat said roughly 60% of this is servers, 40% is data centers and networking. This is the cost of saying yes to $462 billion of cloud backlog. Every cost line grew. Cost of revenues up 14%, R&D 26, sales and marketing 23, G&A 21. R&D is the fastest running line. That's AI talent compensation and depreciation flowing in. Sales and marketing is the Gemini app push. And yet, despite every line growing, operating margin expanded 2 points. Why? Because revenue grew 22 and total cost grew 18. Operating leverage is real, even with this much spending. For now, where $45.8 billion of operating cash got deployed, plus more. $35.7 billion to CapEx, $33.6 billion to acquisitions, mostly the Wiz deal that closed in March, $2.5 billion in dividends. And to fund the gap between operating cash flow and total spend, Alphabet issued $31 billion in fresh long-term notes. Net of repayments, roughly $30 billion. Operating cash flow this quarter didn't cover what they wanted to spend, so they borrowed. $0 of stock buybacks this quarter. A year ago, in the same quarter, Alphabet bought back $15 billion of its own stock. This is one of the largest year-over-year capital allocation swings ever seen at this company. Every dollar of operating cash plus borrowed dollars is going somewhere else now. CapEx acquisitions. The 5% dividend bump is the only shareholder return on the table. If you bought Goog for the buyback, you bought the wrong story. The balance sheet response. Cash and marketable securities steady at $126 billion. Operating cash came in, but it left the same quarter on CapEx and Wiz. Long-term debt jumped from $46.5 to $77.5. $31 billion of new notes issued labeled general corporate purposes, landing in the same quarter as the $35 billion CapEx print. The dividend was bumped 5% to 22 cents per share. That's the shareholder return story in full. What Alphabet committed itself to for this year and the year after. CapEx guidance 2 years ago, $52 billion. Last year, $91 billion. This year, $180 to $190 billion. They raised it from $175 to $185 when they reported. And the line that mattered most on the call was on it saying 2027 CapEx will be, quote, significantly higher than 2026. 3 doublings in 3 years with no peak in sight. They're committing to a CapEx trajectory that locks in depreciation expense for the rest of the decade. The pipeline. $462 billion in cloud backlog end of Q1. Roughly half converts to revenue in the next 24 months. That's about $230 billion landing through Q1 of 2028. Most of it is standard GCP consumption contracts. A smaller piece is the new TPU hardware sales business, selling TPUs into customer-owned data centers. Most of that revenue lands in 2027, and one mini headwind. Wiz, the cybersecurity acquisition, will drag cloud's operating margin by a low single-digit point for the rest of this year while it integrates. 5 things to watch into Q2. 1. Does cloud growth stay above 50%? The backlog says yes. 2. Does free cash flow keep deteriorating? Q1 was $10 billion versus $24 in Q4. 3. Does search ad coverage expand beyond the historical 20% of queries? Schindler suggested it might. 4. Do buybacks restart or is 0 the new normal? And 5. When does the first TPU hardware revenue land? Plus, Google I/O on May 19th and Marketing Live mid-May will give us the product roadmap that drives the next 2 quarters. Verdict time. Both sides have real arguments. Here's the balance. Bull side 6 points. Cloud growth, backlog, search reacceleration, margin expansion, subscriptions, the full stack moat. Every operating metric is healthy. Bear side 6 points, free cash flow down 47%, zero buybacks, 31 billion in new debt. Half the EPS lift was paper. CapEx guidance 180 to 190 this year, higher next year, and network ads going backward. The interesting thing is, and it's not the same kind of evidence on each side, the bull case is about the operating business today. The bear case is about the cash flowing out and what gets depreciated against it later. 190 billion. The high end of Alphabet's 2026 CapEx commitment. And 2027 will be, quote, significantly higher. Whether the backlog converts on schedule is the entire Alphabet story for the next 4 quarters. The bet has been placed, that's the verdict. But earnings season never stops, and the next breakdown is already in the works. Numbers first, narrative second. Hit subscribe so the next one lands in your feed. See you next video.